After weeks of declines in the S&P 500, the week of March 17th through March 21st saw the S&P finish slightly up from its close on March 14th, but still essentially flat. However, since its high close on February 19th of 6,144.15, the S&P 500 has declined 8.2%. While technically not correction territory, it did enter correction territory, defined as a 10% decline, at points in mid-March. So, right before the correction, I discussed buy prices of certain stocks and if their market prices were close. Well, many of those are much cheaper today, and I want to add a few more to the list as the bulk of earnings season has wound to a close. Has this correction made some of the best businesses in the world worth buying? Welcome to The Quality Investor. As you might have noticed, my background is a little bit different. I've been spending the last week and a half or so moving, and it's taken up quite a bit of my time, and that's the reason why I have not been posting as frequently. However, let's get back to the video. I want to get right into the price targets, but if you want a refresher on how I calculate the prices or are new to the channel, please check out the video I did a month ago that explains the methodology. It is linked in the description below. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. I won't go over every stock on the list, but I want to comment on the new ones. I believe these businesses have some of the best long-term growth potential in the world. I own many of these, but I think it is important to have an anchor in your mind about what you're willing to pay for stock before buying it. It helps in preventing impulse buys and overpaying for a business. And it forces you to have that ultimate virtue in investing, patience. So let's get right into the list. As of this recording, the S&P is having a pretty good day, up 1.35% so far. Its high for the day is as high as 1.7%. So a bit of a rebound after what we've been seeing over the last few weeks. However, this very may well be a dead cat bounce. So what are the price targets, though, of the stocks that we care about? This is the list I was discussing earlier. Everything in green is what I added to the list, was not on the original list. But before we get into those, I do want to comment on a couple of the original ones. Apple is still trading very high. The price at the original video is at $245, now down to $219. So you can see it still has quite a ways to go, about 13% before it hits my buy price of $190. Microsoft has come down a little bit more, below 400, originally is at 408. I have actually scooped up a few shares myself over the last couple weeks because it was trading so low. It was down into the 380s even. So I think there's still some good value there. And of course, the other Magnificent 7 stocks here, Amazon and Google, are trading way below what I believe their intrinsic value to be. And I still think there's a lot of value for these stocks. Google, I have also been buying a lot more. But on to the new ones. First, we have United Health Group. Now, United Health Group is no stranger to controversy. And they're embroiled in yet another controversy instigated by none other than super investor Bill Ackman. He is accusing United Health Group of fraudulent pricing tactics. He wrote a lengthy post about it on X, I will link to it below, that did tank the stock a little bit, getting down into the 460s, but has since rebounded a little bit and is now sitting above $500. I do think it's a good buy once it's below $480. And that's actually based on a 20% margin of safety. I used to use a 10% margin of safety. I do think there's an element of unpredictability given the amount of Department of Justice investigations ongoing for United Health Group. Costco is a stock I recently evaluated after their earnings. I did a video on that, linked below. And honestly, this is one of the tougher stocks to evaluate. They trade at such a high price. They were as high as $1,078. But have since come down to $924, dipping below $900 at times. To be completely honest, this is really with about a 5% margin of safety for Costco. To get to that 10% level, they'd have to come down closer to $800. But this stock is truly a powerhouse, and I think if it does get below $900, it may be good to buy the dip here, but really that depends on your risk tolerance and what you believe Costco's future trajectory is. Adobe is next, but I want to save that one for last. There's something I want to talk about there with Adobe. Texas Instruments, this is another stock that I believe is actually quite high given its future cash flow potential. It's trading at over $185 right now. My buy price is $135. Now, Texas Instruments has been investing heavily in capital expenditures, which in theory should pay off down the road, but that has hurt tremendously their cash flow. In valuing them at various scenarios, a bear case, bull case, and a base case, you have to account for the fact that on a base case and maybe even a bear case, they're not going to hit these projected higher future cash flows, which they would be in a bull case. And that said, that means their buy price is going to be a little bit low. I do have a 20% margin of safety. The semiconductor market can be erratic, but honestly, I don't see them coming down that far anytime soon. The market still seems to like Texas Instruments despite some of the uncertainty in the industry as a whole. Next is Airbnb. I did a deep dive into Airbnb, evaluating the entire business, looking at their business model, their economic moat, the various risks involved with Airbnb, as well as what their future projections look like. And I came away astonishingly impressed with what they're doing as a business, as well as an assessment that showed me they're highly undervalued. They are trading at right around $130 right now. After their earnings earlier this quarter, they popped. They went over $160 a share, but since tumbled back down to below $120 per share with the market pullback as a whole, before rising up a little bit to settling at where they are now. My buy price for Airbnb is $146 with a 20% margin of safety. I think there's a lot of value on the table right now for Airbnb, and I do believe it is a very strong buy. Check out that Airbnb deep dive on what my investment thesis is for this travel stock. Now, let's get back to Adobe. Adobe has certainly been out of favor in the market. They went as low as $374 a share earlier this year. Bounced back slightly, but the last year, even a couple years, has been very unkind to Adobe in the stock market. Year to date, Adobe is already down 11.2%. On a 1-year basis, they're down 21%. And on a 3-year basis, they've lost 3% annually. So it's been a frustrating run for Adobe shareholders. I've done multiple videos on Adobe, and what I believe is their very strong economic moat, as well as discussing the risks surrounding Adobe regarding their AI product Firefly, as well as the risks surrounding AI and regarding SaaS business models in general. I do believe that's where a lot of the sentiment is coming from for Adobe. But one thing is certain about Adobe: they continue to grow. They grow the top line, they grow the bottom line, they're growing their margins, and they're growing their free cash flow. So my buy price of $460, there's about 16.5% upside before they reach that target. And that's with a margin of safety of 20%. But how bad is it for Adobe? What do the actual numbers say? Well, their income, gross profit, and operating income, we've seen a continual rise over the last 10 years. They consistently grow their revenue at least 10% per year. Their gross profit up even more than that, which means they're expanding margins. Operating income growing faster than revenue as well. Earnings per share, a bit of a slowdown. However, there are some mitigating circumstances around their earnings per share number in their fiscal year of 2024. I've explained that in my Adobe videos. They're also buying back shares. They don't pay a dividend, so this is how they're rewarding shareholders. And of course, the most important number, in my view, is the free cash flow. Look at this steady increase in free cash flow. They're compounding their free cash flow. And not only that, they're an incredibly capital light business. They have a minuscule amount of capital expenditure outlays. But as you can see in the market capitalization chart here, since fiscal year 2021, they've been out of favor in the market, slowly declining every single year. If we're looking at the margins, to me, this is even more impressive. Their trailing 12 gross margin is at nearly 90%. How many other businesses can boast that? Their operating margin is also growing, 36.3%. 10 years ago, it was at 18.8%. Their free cash flow margin has also been growing, now at 41.7%. And of course, their return on invested capital sits at a staggering 88.7% for ROIC and at 45% for ROC, or return on capital employed. And the trend line is steadily going up. And just to refresh everybody, ROIC is what a business can reasonably expect to return over time. I'm going to do a more in-depth video on Adobe, but I think a lot of the risks surrounding Adobe are a little bit overblown. They have a subscription-based business model and a very strong economic moat with their product offerings. There's high switching costs for users of Adobe products, and not only that, they're considered the industry standard when it comes to photo and video editing software. So stay tuned for that Adobe in-depth video. A few other businesses I just quickly want to comment on. Applied Materials continues to fall, making it even more attractive as an investment. My buy price of $190 compared to their current price of $155. And another business, which I really like, that I definitely wish came down more during this little market correction, is Fortinet. I want to see that come down under $90. And a few other businesses I don't own that are on my watch list: KLAC, CDNS or Cadence Design Systems, and Fair Isaac, all are still a little bit overvalued in my view. In fact, they really haven't come down all that much since my original video here. KLAC has come down a little bit from their price a month ago when it was at $754, but Cadence Design and Fair Isaac are actually higher than what they were a month ago. Cadence was at $258 and Fair Isaac was at $1,698. It's very possible I missed the boat again on Fair Isaac. While this market correction has caused a lot of angst out there among media members, the public at large, the businesses which I believe to be some of the best in the world still have not come down to some targets which I think are more attractive as buy prices. But we will see how the S&P reacts over the next weeks and months. Perhaps we're just at the beginning of this corrective cycle, and we're going to get some nice price declines in some of the better businesses in the world. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.